Fishing in low IVR environments. Let's take a look. With the stock market implied volatility and its IV rank low and unattractive for short options trades, is there value in going to single stocks with slightly higher IV or IVR levels? So we're fishing for higher IVR. Is there an advantage going to Microsoft, Apple, Amazon, and NVIDIA with higher IV ranks and obviously higher implied volatility? What do you think, Mr. Batista? In low IV,
do I think with low rank it would be attractive? I mean, I think it's still gonna. I think the probability of success is still gonna work out, but it's got to be, I think, a little less advantageous with low implied volatility.
So the stocks we are looking into have both consistently been a top holding of the S&P 500, which means that they are super liquid, and they've held a volatility higher than the index when IV was low or high. So again, you can see here the position, their ranking in the S&P 500. First, second, third, and NVIDIA's gone from 57th to third, and it was first a couple days ago. So with a high correlation to the broad market, we can attempt to get an edge with higher implied volatility in these single stocks that apparently move like the S&Ps. If you take a look at this, let's see the correlations: 0.91, 0.77, 0.85, 0.94, 0.71, 0.7. Yeah, they're all highly correlated. All of them highly correlated. So we did a study. We compared a 1 standard deviation, 16 delta strangle in single stocks to the stock market, which is the S&P 500, and filtered for low IVR in the S&P 500. 45-day expiration options, trades managed at 21 days, 2010 to present. This was a request that I made to our research team and a couple of other people made to the research team. Hey, let's take a look at this. Everything's managed at 21 DTE. All trades, 2010 to present. The first thing that you notice is the success rate of the SPY was 69%. Microsoft is a little higher, Apple's a little lower, Amazon's a little lower, NVIDIA's a little lower. So the success rate, no bueno. The average return on capital, this is going to be very mixed because NVIDIA because the size of that move took down everybody. Sure. Microsoft a little bit better, Apple worse, Amazon worse, NVIDIA worse. Then we're looking at the standard deviation. So did you take more risk? And the answer is you sure did. And did you have? That's got
to be a typo in Amazon. It can't be 14,000, can it?
I guess. I'm not going to assume any typos. The CVAR, even if it's 1,400 and they're off by a decimal, which I don't think they are, it would still be higher than the SPY. And
sure,
the average P&L, Microsoft's about the same. Apple's the other way. Amazon is very positive, and NVIDIA is not. There is nothing in this study right here that is conclusive enough to suggest that you could have easily chosen between Apple, Microsoft, Amazon, or NVIDIA, and you would have probably had less risk, a lower standard deviation of risk, the same average P&L, and about the same success rate, and you would have taken a lot less risk if you had just done SPY, that's all trades with no filter for IVR. I'm guessing that with high IVR, it's going to look very differently. So when the implied volatility rank was lower, and there's a ton of research in here, the S&P 500 strangles experienced only a slight reduction in profitability compared to individual stocks. In contrast, individual stocks exhibited significant shifts in risk under the same conditions, though the success rate remained relatively consistent. And again, if you take a look here, the return on capital for Apple, Amazon, and NVIDIA in low IVR was negative. The standard deviation was huge. The C-bar was huge compared, and the average P&L in all three of those four was negative.
It's horrible.
Low IV rank, no bueno.
Yeah, it stinks. Yeah, you're right.
Low IV rank in the S&Ps. Now, that's kind of what I thought would happen. If the next slide doesn't show an improvement, then that's going to scare me a little bit. Oh, they didn't do the higher one. Oh, okay. They just looked at that low fishing. Oh, yeah, fishing in low IVR environments. If you looked in the higher IVR environments, I guarantee you that it's going to be a lot better. A market having higher implied volatility than a market that highly correlated to does not guarantee profits or greater profits. Despite the greater change in risk levels for individual stocks compared to the SPY, the probability of success remained consistent. This suggests that while risk profile differs, the likelihood of achieving a profitable outcome does not significantly change. This could be interpreted that the strategies adapted to low volatility environments are effectively managing the risk-return trade-off. Though periods of low IV can be frustrating, sticking to IV rank as a measure for the individual market is essential. kind of confirms what I have found for a long time. In low IV environments, trading these individual stocks like NVIDIA have been quite difficult. Apple, the same thing. Amazon, the same thing. Google, the same thing.
Apple up 450, by the way, trying to save this market.